Right now, while you're watching this video, your savings account is losing money. Not because you spent it, not because the market crashed, but because your bank is paying you almost nothing on your deposits and quietly pocketing the difference themselves. The average traditional savings account in America pays around 0.5% interest per year. Meanwhile, high-yield savings accounts available to anyone with a phone and 15 minutes are paying between 4% and 5% right now. On $10,000, that's the difference between earning $50 a year and earning $500. That gap? Your bank keeps it. Today, I'm going to show you exactly what a high-yield savings account is, how it works, why it's one of the smartest and safest financial moves you can make right now, and how to open one before this video ends. I'm Emma. Welcome to Emma Invests. Let's get into it. Let's start with the basics. A high-yield savings account, or HYSA, is exactly what it sounds like. It's a savings account, just like the one you probably already have at your bank. You deposit money, the bank holds it safely, and you can withdraw it whenever you need it. The one difference, and it's a massive difference, is the interest rate. While traditional savings accounts at big banks like Chase, Bank of America, or Wells Fargo pay somewhere between 0.01% and 0.5% annually, high-yield savings accounts typically offered by online banks pay anywhere from 4% to 5.5% annually right now. Let me put that into numbers you can feel. Say you have $5,000 in savings. In a regular savings account at 0.5%, you earn $25 a year. In a high-yield savings account at 4.5%, you earn $225 a year. Same $5,000, same zero risk, just a smarter place to keep it. And before you ask, yes, it's completely safe. HYSAs at FDIC-insured banks are protected up to $250,000 per depositor. Your money is just as safe as it is at your local bank branch. It just earns a whole lot more. Now, you're probably wondering if HYSAs pay so much more, why doesn't every bank offer them? And why didn't anyone tell you about this sooner? The answer is simple: overhead and incentive. Traditional big banks have thousands of physical branches, tens of thousands of employees, ATMs on every corner, and billions in operating costs. To cover those costs, they pay you as little as possible on your deposits and lend your money out at much higher interest rates. The spread between what they pay you and what they charge borrowers? That's their profit. And they've been doing it for decades. Online banks, the ones offering HYSAs, don't have that overhead. No physical branches, minimal staff, lower operating costs. So they can afford to pass more of that interest directly back to you, the depositor. It's not magic. It's just a better business model for the customer. And here's something that might surprise you. Many of these online banks are just as established and trustworthy as your traditional bank. Institutions like Marcus by Goldman Sachs, Ally Bank, SoFi, and American Express offer HYSAs, all FDIC insured, all regulated, all legitimate. Let's talk about how the interest actually works, because this is where it gets interesting. Most HYSAs pay what's called APY, annual percentage yield. This is the effective interest you earn over 1 year, including compounding, and compounding is the key word here. With most HYSAs, interest compounds daily and is deposited into your account monthly. That means every single day, you're earning a tiny slice of interest, and that interest then earns interest the next day. It's a snowball effect, and over time, it becomes very powerful. Here's a real example. You deposit $10,000 into a HYSA at 4.5% APY. After 1 year with daily compounding, you don't just earn $450. You actually earn $460 because the daily compounding adds slightly more than simple interest. Small difference in year 1, but over 5 years at the same rate, the difference between simple interest and compound interest on $10,000 grows to hundreds of dollars. Now, here's the important thing to understand. HYSA interest rates are variable. They move with the Federal Reserve's interest rate decisions. When the Fed raises rates, HYSA rates go up. When the Fed cuts rates, HYSA rates come down. So the 4.5% you see today might be 3.5% or 5% next year. That's not a flaw, it's just how they work. And even at lower rates, they still beat traditional savings accounts by a significant margin. So now that you understand what a HYSA is and how it works, what should you actually use it for? A HYSA is not an investment account. You're not going to retire on HYSA interest alone. It's a savings vehicle perfect for money you want to keep safe, keep accessible, and have earned as much as possible while it sits. The number one use case is your emergency fund. As I've said before on this channel, your emergency fund is the foundation of your financial life. 3 to 6 months of living expenses, liquid and accessible at all times. A HYSA is the absolute perfect home for that money. It earns meaningful interest while staying completely liquid. You can transfer it to your checking account within 1 to 3 business days if you need it. The second best use? Saving for a specific goal. Planning a wedding, saving for a down payment on a house, building a travel fund. Any money you're planning to spend within the next 1 to 5 years should not be in the stock market. The risk is too high for short time frames. But it absolutely should be in a HYSA, earning 4% to 5% while you save up. The third use, your monthly cash buffer. Any savings beyond your checking account that you might need within the next 3 to 6 months? Park it in a HYSA instead of letting it sit idle in a zero-interest account. Now let's clear up what a HYSA is not, because there are a few common misconceptions that could get you into trouble. A HYSA is not a checking account. You typically can't use a debit card directly from your HYSA, and some accounts limit how many withdrawals you can make per month. It's designed for saving, not daily spending. A HYSA is not an investment. The interest is real and meaningful, but it won't grow your wealth the way investing in index funds or the stock market can over the long term. Think of it as the safe, stable foundation, not the engine of your wealth. A HYSA is not a CD or money market account. A certificate of deposit locks your money away for a fixed term in exchange for a slightly higher rate. A HYSA keeps your money fully liquid. Different tools, different purposes. And perhaps most importantly, a HYSA is not too good to be true. It's a legitimate, FDIC-insured, well-regulated product. The only reason most people don't have one is simply because their traditional bank never told them it existed. Funny how that works. All right, so you're convinced. You want a HYSA. How do you pick the right one? Here are the 5 things to look for. Number 1, APY rate. This is the headline number. Compare current rates across institutions. Sites like Bankrate and NerdWallet update these daily. Look for anything above 4% in the current rate environment. Number 2, FDIC insurance. Non-negotiable. Never park your savings at an institution that isn't FDIC insured. Check the fine print. Number 3, no monthly fees. Many HYSAs are completely free. If a bank charges a monthly maintenance fee, that eats directly into your interest earnings. Avoid it. Number 4, minimum balance requirements. Some HYSAs require a minimum deposit to open or to earn the advertised rate. Many have no minimum at all. Know the terms before you open. Number 5, ease of transfer. How quickly can you move money between your HYSA and your checking account? Most good accounts offer 1 to 3 business day transfers. Some offer same day. That matters when you actually need the money. Top options right now include Marcus by Goldman Sachs, Ally Bank, SoFi, Discover Online Savings, and American Express High Yield Savings. All FDIC insured, no monthly fees, competitive rates. Opening a HYSA is genuinely one of the easiest financial tasks you will ever do. Here's how it works, step by step. Step 1, choose your bank. Pick one of the institutions I mentioned, or do your own comparison on Bankrate. Takes 5 minutes. Step 2, go to their website or download their app. Everything is done online, there's no branch to visit, no appointment needed. Step 3, fill out the application. You'll need your name, address, social security number, and a government-issued ID. Standard stuff, the same information you'd give any bank. Step 4, fund your account. You'll link your existing checking account and initiate a transfer. You can start with as little as $1 at most institutions. There's no minimum required to begin. Step 5, Watch your interest grow. Log in once a month, check your balance, and watch the interest appear. That's it. The account does the work. From start to finish, choosing a bank, applying, and funding, you can have a fully operational HYSA in under 15 minutes. There is genuinely no reason to wait. Every day you delay is a day your savings earns nothing when it could be earning 4% to 5%. Before we wrap up, I want to talk about the mistake I see people make after they open a HYSA because it's more common than you'd think. They open the account, they fund it, and then they stop there and think they're done with their financial life. A HYSA is not the finish line. It's the starting line. Your HYSA is where you park your safe money, your emergency fund, your short-term savings goals, your cash buffer. But the money that you won't need for 5 or more years, that should be invested. In index funds, in retirement accounts, in assets that grow at 8%, 10%, 12% over time, not 4.5%. The biggest financial mistake people make is keeping too much money in savings, including in a HYSA out of fear or inertia. 4.5% feels safe. It is safe. But it won't build wealth over decades. Investing will. So here's the framework. Emergency fund plus short-term goals go in the HYSA. Everything beyond that money you won't need for 5+ years goes into investments. Both engines running together is how you actually build financial security. Here's what I want you to do before you close this video. Open a new tab. Go to bankrate.com. Search high-yield savings accounts. Pick one with a rate above 4%, FDIC insured, no fees. And start your application. 15 minutes from right now, you could have an account that earns 10 times more than what your bank is currently paying you. There is no reason to wait another day. If this opened your eyes to how quietly your traditional bank has been shortchanging, you hit subscribe. Every single week on Emma Invests, I break down one financial concept that your bank, your school, and your employer never bothered to explain in plain English, no jargon, no fluff. And if you want to know exactly what to do with your money once your emergency fund is fully funded, watch my next video where I walk you through investing your first dollar in an index fund step by step. I'm Emma. Your money should be working harder. Starting today.